Understanding the various corporate finance careers. What is investment banking? An investment bank is a financial intermediary that sits between those with capital and those who need capital. Essentially, investment banks provide liquidity in the market. On the institutional side, investors put money into professional money managers that we call the Buyside. Investment banks work with these institutions to provide them opportunities to invest this capital. On the corporate side, many times companies require additional capital for various reasons. Investment banks will help these companies raise that capital, usually in the form of debt and equity, and oftentimes from those institutional investors that are looking to put money to work. Front, middle, and back office. Before we go any further, it's important to understand what a front office means for any company. The front office refers to the main function of the company that drives revenue. For example, consultants at a consulting company, investment bankers at an investment bank, and programmers at a tech company. The middle office and back office refers to support functions at a company that are needed to help keep the company running. The middle office refers to jobs that sit between the front and the back office. For example, risk management at a hedge fund. Back office generally refers to support functions. This could be human resources, accounting, trade support, IT, and other operations. Therefore, recruiters at a recruiting firm are considered front office, but recruiting at an investment bank would not be considered front office. Investment banking divisions. Front office divisions at an investment bank. Most people that go into investment banking are generally interested in the investment banking division. This includes M&A advisory, equity capital markets, and debt capital markets. Other front office divisions include sales and trading and research. These front office divisions are what's typical for what's called a pure play entity. There are boutique investment banks and bulge bracket banks that have these divisions. The boutique investment banks will probably just have the ones mentioned. The larger conglomerate entities such as Bank of America and JP Morgan Chase will have other functions as well, such as corporate banking, wealth management, and investment management. Just a quick overview of the different groups in these divisions. Within the M&A group, they help companies buy and sell whole divisions of other companies. Within equity capital markets, the goal is to help companies with primary and secondary equity issuances. This will be IPOs, for example. Within debt capital markets, this is the group that helps companies raise all sorts of debt. All debt raises including secured and unsecured debt, refinancing of debt, and hybrid debt instruments. For sales and trading, the trading group refers to traders within an investment bank that trade certain products such as equities, currencies, commodities, and certain types of debt. Traders make money on volume and volatility. The salesperson is a point of contact between an investment bank and an institutional investor such as a hedge fund. They will help provide the different products and services to the client. Oftentimes, they refer research analysts to these buy-side clients to help them with potential investment ideas. For the research division, this is normally split between equity and credit research. The analyst in this division publishes research on a specific stock or a specific credit. Oftentimes, this goes to institutional investors to help inform them and advise them on potential investment ideas. Types of investment banks. There are three main categories: bulge bracket, middle market, and boutique. Bulge brackets are the big investment banks that have many divisions. This would be, for example, Goldman Sachs, Morgan Stanley, JP Morgan, and Citigroup. Middle market investment banks are banks that work on smaller deal sizes. This will include Houlihan Lokey, Jefferies, Sandler O'Neill, and Cohen & Company. The boutique investment banks, they can range from small investment banks that work on very big deals, which are called the elite boutiques, to boutique investment banks that work on smaller deals. The elite boutiques will include Evercore, Lazard, Moelis, and Centerview, for example. Within each investment banking product, such as M&A or equity capital markets, or even within sales and trading, they are further organized into industry groups. For example, healthcare, tech media telecom, industrials, and power and utilities. The M&A group may be its own separate group outside of the industry groups, depending on how each investment bank organizes its M&A group. Each division will cater to different clients. The investment banking division generally works with corporations and private equity firms. Sales and trading and research works with hedge funds and mutual funds. Sellside versus Buyside. What's the difference? The sell side is traditionally referred to as advisors. Advisory services within investment banking include M&A, equity capital raises, and debt capital raises. Advisors earn fees based on the total volume of transactions, regardless of outcome. Outside of investment banking, other examples of sell-side advisors include consultants, lawyers, and real estate brokers. They make money based on the volume of transactions that they do. On the buy side, this is usually referred to as investors. Investors invest in a company and make money based on the increased value of that investment. They care about the outcome. It is not as much about the total volume of transactions that they do. Buy-side advisors put their own capital at risk. They may acquire a minority, a majority, or a wholly owned asset, and they realize value when that stake is sold. Examples of the buy side include private equity firms, hedge funds, and outside of finance, real estate investors. Other things to note: this is a relationship business for sell-side firms, therefore branding and the quality of service for their clients matters. Oftentimes, this leads to long hours because of that client servicing nature. So, how do you tell the difference between the sell side versus the buy side? Imagine both an investment bank and its client are upset about an event. The sell side hangs up first and then says F you, whereas the buy side firm says F you and then hangs up. Career paths. For those looking to stay in investment banking, this is the corporate ladder within an investment bank. For an American investment bank, it starts at analyst, then goes to associate, VP, director, and then managing director. Analysts usually start after undergrad, and associates start after an MBA. For a European investment bank, it goes analyst, associate, director, executive director, and managing director. The director level is equivalent to an American VP, and the executive director is equivalent to an American director. For someone going into investment banking out of undergrad, the typical path is to work in investment banking for 2 to 3 years before jumping over to the buy side in a private equity or hedge fund role. Most people go into a private equity program after 2 or 3 years in investment banking, and then after an associate program at a private equity firm, most people either do an MBA or go directly to a hedge fund. During an MBA, most people will either choose from that position to go back into private equity, go to a hedge fund, or do something completely differently. Obviously, in this progression, people may choose to leave the industry altogether. For those that do leave the industry, other career opportunities include joining big tech, such as Google or Facebook, leaving for investor relations, or going to a startup. Why do analysts leave investment banking? There are many reasons why analysts may leave. Investment banking, for one, has very long hours and the culture may be tough. For many analysts, they want to be an investor on the buy side. Also, when it comes to pay, in private equity, as you move up, you may be allocated carried interest in addition to your cash bonus. Carried interest is a share of the profits earned by the general partners or those invested in the fund. Other reasons include lifestyle, the realization that this industry is not for them. They want a different job or a different function, for example, going into tech, and they want to explore other careers. With time, people will have a better understanding of which careers are best for them. And investment banking may just be the start of their career. Like, comment, and subscribe for more content. Also, visit our website at www.wallstreetsmart.com for additional resources.